Hi, my name is Steve Billimack, and I'm a partner in the Chicago office of Hightower Great Lakes. And today I wanted to take some time to just give a brief overview of tax loss harvesting. In volatile years like 2022, tax loss harvesting can be applied to some of our clients that have taxable accounts. This doesn't apply to tax deferred accounts such as IRAs, but taxable accounts that have positions trading at a loss from the original purchase price. And this year, with both bonds and stocks being volatile, there's some potential opportunities in both bond and stock positions within portfolios. So what we would do is we would sell that position for a loss, and then that loss can be used in future years or the same calendar year to offset realized capital gains that you may have from the portfolio. Now, your CPA or tax advisor can give you the best advice on how this impacts your return. This is more of a general overview. Typically, when talking about tax loss harvesting, there's some terms that come up. One you'll hear about is the wash sale rule. And this basically is an IRS rule that says if you want to count those losses on your taxes, you cannot own a substantially identical position within 30 days of selling the position. And so what some people do is they'll sell a position and have the proceeds sit in cash, and then after 31 days, buy back the original position. Now, the disadvantage of that is if the market has a dramatic move upside, you're in cash, and you're not really matching your asset allocation or your investment themes. So typically what we would like to do is if we sell a position, we would like to replace it with a similar position rather than substantially identical position. So examples of this would be substantially identical position would be if we own the S&P 500 mutual fund or an ETF, we sold it and we bought the S&P 500 futures within that 30-day window, that would be a substantially identical position. Basically, you're replacing one with the other and they're the same. From a similar perspective, though, we could replace the S&P 500 with the Russell 1000 value mutual fund or ETF. And in that case, it's technically a similar position. Both are U.S. focused, both own, have a large cap bias to them because they're market cap weighted. So the top holdings are similar in order and slightly different in percentages because the one has 500 extra stocks, but they're not a big weight of the portfolio. So that would allow us then to, in this example, hold that Russell 1000 going forward, or after 31 days, we could replace it and go back to our original investment and still qualify that loss for tax purposes. Another consideration that comes up is short-term versus long-term. So short-term is any position gain or loss you've realized and you've held the position less than a year, and long-term would be longer than a year. And the most typical tend to be long-term gains or long-term losses. So let's say we have a bank of long-term losses that we built up. Again, we can use those to offset gains, long-term gains from the same year. If we have excess losses, you can deduct $3,000 of that from your federal tax return. And then if you have excess losses beyond that, it's important to note that those losses carry forward to future years. So again, we think it's a good opportunity if it's available to build a loss bank to help offset future gains. And it's important to note that, again, we're not making this decision based solely on taxes. We're doing it in conjunction with your asset allocation and your other investment themes. So that's very important. Again, we've been long-term investors, and so we tend to rebalance portfolios gradually. So the one thing you would see in a tax loss harvesting world is you may see more trades than you would normally. But again, the whole idea here is to try to optimize after-tax returns for your portfolio. So thanks for taking the time. Again, if you or your CPA have questions, we'd be more than happy to go over the concepts or see if this applies to your own personal portfolio. Thank you.